Good day, everyone. I hope you are all well. We have Peter Ristevski with us here today. Peter is One Life Club member, and Peter also is living in beautiful Sydney. I hope Sydney is beautiful as Brisbane today because you have blue sky here. And Peter's specialty is accounting. That's the business that he's running. And we got a hot topic to discuss today. So Peter, I'm going to let you introduce yourself and I'm going to let you to take over from here. And then after you finish, if anybody has any questions as well, more than welcome to ask Peter.
Thank you, Emil. Thank you for the introduction. And thanks, guys, for joining us on this very, very interesting topic. A topic that's people talking, and it's been an election issue. It's been sitting in Parliament for 2 years, and a lot of the stuff that I will be talking about, who knows if the legislation will head that way. But looking at the results of the last election, where the Labor Party, who are the sponsors of this new legislation, received an overwhelming majority, and the Liberals really got whacked in the lower house. And furthermore, they also got whacked in the Senate. So the Senate's the key with this legislation, because this bill has actually passed in the lower house. This bill has actually passed in the lower house. Sorry, guys, I'm also sharing a screen if everyone can see that. As I talk, I'll have the things on the screen that we can refer to. And if anyone does want to ask a question, feel free. We'll make it like a conversation rather than a seminar. But coming back to the legislation, it's more than likely it will pass, because the makeup, although it hasn't finally been determined, the Labor Party, together with the Greens, control the Senate. The Liberals have lost a few seats, a couple of the independents, but it's not enough to put a stop to this legislation. Let's go over to the next screen. So a bit of background. This tax is kind of flipping our tax system really upside down. It's something that's never been done before. And once you tell people we're going to be taxing unrealized capital gains, everyone freaks out. And by all means, they have every right to freak out, because there are a few countries that are doing this in the world, like Norway and Switzerland. Now, more than likely, with this bill passing, I think, in the upper house with the power of the Greens actually want to lower the threshold down to $2 million, which is even worse. But I don't think that will happen. The government has actually gone into this election with this as an election issue, saying it will be $3 million. So I don't see them going back on that. So we can be more than confident that the threshold will be set at $3 million. And the other unfortunate thing is it won't be indexed. Now, why won't it be indexed? The Treasurer has come out and said, well, our tax brackets aren't indexed. Why should this be indexed? Whether that's a valid reasoning or not, it will be seen. But over the years, more and more people will be captured by this new rule. More and more people will be captured by this new rule as they move into the $3 million threshold. One thing that concerns me about this legislation, especially the taxing of the unrealized capital gains, is I think it sets a very, very dangerous precedent. Yes, this has been taxed within the super framework, but knowing governments and knowing our deficit in the future, what's to stop them introducing something like this outside of superannuation? So it's something to keep in mind. A couple of key dates. The key date is 1 July 2025. Even though the legislation won't be passed on the 1st of July 2025 because the Parliament's not being recalled until August, they're going to have to make it retrospective. So that will be the date when a line will be drawn in the sand to determine your liability to this tax, 30 June 2026. Basically, the way it works, and it's quite a quite a very complicated calculation. This tax is pretty much a separate tax. It's a separate tax that only applies to the proportion of your superannuation balances that exceed $3 million. So that's the first step to sort of keep into consideration whether you exceed the $3 million threshold. If you don't, then you've got nothing to worry about at this stage. Basically, we'll be taxed also at a 15% tax rate, and it applies to the percentage, this is the key, the percentage that your total superannuation balance exceeds $3 million. The percentage will determine the amount of tax you pay. And this tax is also separate and in addition to the 15% tax that already applies to superannuation funds in the accumulation phase. Now, one thing I must also make note of, which is a little bit different to the 15% tax within superannuation, the tax is actually levied on the individual who has a choice. He's got two choices: to pay the tax either personally, outside of super, or to pay it from their superannuation fund. So it kind of takes away the sting a little bit, but not so, but it does give you that option. And there are a couple of exemptions to this rule. In particular, one that I'll mention, I won't go into all of them. If a person passes away, then they are not subject to that Division 296 tax in the financial year that they pass away. So just put the screen on that. So a couple of things about this calculation. Sorry, this one. A couple of things about this calculation. How do I explain this without using a real life scenario? And using a scenario based on legislation that hasn't passed, we'll just have to bear with it. I had a client, let's just call him John. He's age 50. In his superannuation, he's in the accumulation phase because he hasn't reached the transition to retirement age yet. He's got an SMSF balance of 11.5 million, I'd say at 30 June 2025. Now, if his superannuation balance goes to say 12 million at 30 June 2026, how does this tax affect him? Now, complicating it even further, in the 2026 financial year, he makes a superannuation contribution of $20,000. Now, the way this will work is a couple of steps. Firstly, is his balance over $3 million? Yes, in this case it is. It's 12 million at 30 June. And what we do is we take the balance at 30 June 2026. So in this scenario, it's $12 million. We minus any withdrawals that he's taken throughout the year. We also minus any contributions that he's made. And then we also, sorry, we plus the withdrawals. I said minus. We plus the withdrawals, we minus the contributions, and then we minus his balance at 30 June 2025. That figure must be more than zero. If it's not, then he's exempt. So that's the key in this calculation. You take the balance at 30 June 2026 plus his withdrawals during the year, minus his contributions, minus his balance at 30 June 2025. If it's greater than zero, then he's actually part of this new taxation. So how do we calculate it in this scenario? So John has a balance of 12 million at 30 June 2026. He made a contribution of $20,000. Now, the other advantage is we take the contribution net of tax. So if you take the 15% tax away from the $20,000, it gives him $17,000. Furthermore, we minus his balance at 30 June 2025, which was 11.5. So he has $483,000. It's greater than zero. His balance is more than $3 million. Therefore, he's subject to this new tax rate. Now, the amount of tax also is determined by the percentage he's over the $3 million. You might have two clients that have similar balances of say $483,000, one might be over the $3 million balance by 5%, another might be over by 75%. Like in this case, John is over by 75%. The way we determine the 75%, his balance at 30 June 2026 was $12 million minus the $3 million threshold gives him that 75%. So coming back to my scenario, the amount of dollars he had over the amount of dollars he had over zero was $483,000. So the way we determine how much tax he pays, we take 75% of that. By the tax rate of 15%, his tax liability is roughly around $55,000. Now, I know that sounds a very, very complicated calculation, and I'm happy to stop and explain it to anyone that may want further explanation. Just reach out. But one thing I also need to make point of, if your superannuation has borrowings, for example, a non-recourse loan for a property, even though from a normal perspective, you take the net asset position, but under this tax, it's ignored. It's completely ignored, which makes it even more unfair, per se. People on the screen? People on the screen, so to speak. Yeah, one second. Sorry, guys, I've just got someone helping me with the screen. So does that make sense for people so far? I know it's a little bit complicated, but firstly, you just got to work out if you're over the $3 million. Then you've got to work out what percentage you're over, and then you calculate the tax based on that. I can actually provide these screens to everyone so they can actually see it in greater detail. Now, if we go to the next question, which most people want to know, is what's the solution? How do we navigate through this? We're subject to this tax. What do we do? Basically, there's a few scenarios. You can split your contributions with your spouse. So if you're at $3 million and she's at, say, $1 million, you can actually throw more money towards her superannuation. Maybe in terms of your asset allocation in your super fund, you may want to just keep defensive assets like cash and bonds inside of super if you're over the $3 million. Maybe in terms of the growth assets like shares and property, we keep them basically outside of super. Other assets, you may want to look at fully franked dividend assets, shares that give you an opportunity to reduce your tax liability. But one thing that I think that this tax will do will probably make Australia uninvestable. Now, a lot of super funds that I know, because of the fact that they've got money in super and it's not your hurt money. A lot of people don't mind investing in risky assets through their superannuation funds. Problem you've got, these type of investments in Australia are very good for the country. They're productive. They provide the growth for our economy. They drive innovation. They commercialise research and development, especially in the pharmaceutical industries. But this government has taken a short-term view where they want to tax you on unrealised gains, which then puts these kind of investments out of the sphere of SMSFs. If I can give you a perspective into what I mean by this is, for example, you invested in a startup. Now that startup, somehow its valuation increases by an astronomical amount. Because of that very reason, you are now subject to this tax. The problem you have is you've got shares in this unlisted asset that you pretty much cannot sell to pay this tax. So what do? You're going to have to sell off other assets within your fund, which is going to create diversity risk. And you're going to end up with a large concentration of assets in your super fund in unlisted assets. So what happens when you don't have any assets to sell in order to pay this tax? These are the questions that haven't been answered in this legislation. But one thing I was thinking about the other day is what happens if that startup that you invested in, its valuation then goes backwards? What if it fails? What if it goes into liquidation? And you've paid all this tax all the way through. the thing is, you don't get a tax refund for the tax that you've paid. You actually only get a tax credit that you can offset against future losses. So remember this, if you get a tax refund today, it's not the same tax refund via a credit in 5 years' time due to inflation. But what if your superannuation fund never makes enough money to take advantage of this tax credit? These are some of the astronomical and dangerous things that are happening with this tax that probably haven't been thought out. Now, before everyone jumps in and says, I'm going to withdraw my money out of super and put it into other assets, okay, yeah, that might be a solution, but you need to take into effect everything. You've got to take into effect capital gains tax. If you were to sell this asset, what's the tax in the super fund? Then to buy it in another structure, you've got stamp duty. Then when you distribute, say, for example, from the family trust into individual return, you've got the individual tax rate, which could be at 47%. So you need to look at everything. If you are going to divest from your super fund, put it into other structures like family trusts, companies, or individual names in super, do the calculation. Very, very important. One thing that I looked at with a client of mine, and this is probably a good solution, and kids are loving life at the moment. I had a client that wanted to get below the 3 million threshold to provide his son with an opportunity to buy his first home. Now, what he did was he made a partial withdrawal. Rather than investing it in something else, he's taken it out and given it to his son to purchase a property. So his son's loving life. He's getting part of his inheritance money before his father passes away. Great help for him. But the strategy that I sort of developed for my client was, we need to still protect your position and at the same time protect your son. So we drafted an interest-free loan agreement where his son can't actually sell the property without his father's consent, who ultimately holds the mortgage of the property, because you never know. He may sell it, want to go on holiday, gamble it, whatnot. More importantly, him being a son, I don't know how to say this without being sexist, but the reality is the men walk away a lot of the times with less assets. So his father wanted to make sure that his gift to his son was also protected. By providing him with an interest-free loan, he had that protection. The other benefit of this strategy was by taking it out of his super and giving it to his son, rather than waiting upon his death, his son would have had to pay a 15% death tax in the superannuation fund because he wasn't a dependent. Some of the strategies that we developed for the withdrawal, this new legislation combines both your pension phase and your accumulation phase superannuation. My client had two SMSFs, a pension phase and an accumulation phase. He had $1.9 million in his pension phase fund and 1.6 in his accumulation. Combine the two, he was over the $3 million by $500,000. So he made a withdrawal, not from the accumulation. He made a withdrawal by selling assets from the pension phase fund, which meant he had no capital gains tax. If he did it out of the other fund, he would have paid a 15% tax or a 10% tax if he held the assets for 12 months. So that's another strategy that we implemented at the same time. Now, what my advice is to everyone on this lunch meeting is, let's just wait. Don't do anything drastic. Let's see what the legislation says. Yes, it will pass, but we just don't know the finer detail. We don't want to be making any drastic decisions, and then we can't reverse that decision that we've made. So I'm personally advising a lot of my clients to sit and wait for the finer detail. I won't go into any more. I'm happy to ask and answer any questions if people have. So I'll throw it over to the floor.
Guys, does anybody have any questions for Peter?
That's okay. Look, what I will do, I'll provide these slides and the back notes with it, and then my phone number as well, if anyone wants to have a chat offline, by all means. It is a very complicated tax. There is a lot of uncertainty. You know, the taxing on unrealised capital gains, is it going to be setting a precedent going forward? Let's just wait and see. But thank you everyone for your time.
Thanks, Peter. And I do think it is such a complicated topic that everyone will probably soak in a lot of that great information. So thank you so much. And yeah, guys, if you do have anything you'd like to reach out to Peter, please either let us know or Trista know, or Peter will share his information anyway.
Thank you, guys.
Thanks, Peter, for your time. That was fantastic. Have a great afternoon, everybody.
You too. Take care.